So let's have a look at another example over here so that we can get better cast of it. And I will introduce the concept of what an overbought and an oversold condition is. So to demonstrate the typical type of correction, let's have this example we have here of Security Bank. And if we look at the uptrending part that you see over here, let's just have a look. You can see several times along its upward path, you will see a very, very sudden, abrupt, sharp up move taking place. And you will notice that in these advances, that they go up very, very quickly, but almost as quickly they will stop, turn, and try to make that adjustment that we were talking about earlier. So let's discuss this. In an uptrending environment, the tendency for demand is to be able to become big and normal, big and then back to normal. And that's when the market goes up very, very strongly. So if the stock price moves up very, very strongly, what we say too much too soon, we call this situation or condition in the price being overbought. Now, when we say overbought, that means too much buying coming into the stock price, affecting its movement very, very suddenly. So when that happens, you will see a sudden streak up. The market now becomes overbought. Now let me describe what that situation is like. In an overbought condition, which shows a very sharp upward advance, you are now giving a lot of people who are holding that stock an opportunity to take profit because they're now seeing in that very short term a massive up move in price. And if they have the ability to take that profit, they will. And that act of profit taking will shove that price back down or sideways to contain it from climbing too much. The more you push this higher, the bigger the impact that will be. So I'd like to always remind yourselves, imagine when a stock price is moving along its trend, imagine you have that one rubber band tied into the trend line and the other one tied into the upper end where the prices are. And the more you stretch it upwards, the more extended or overbought it becomes. And that means more gravitational pull on the stock that will allow it to go back down to the trend line. And here's what we were talking about earlier. Do not chase prices this way. If you've missed the window, just wait for the next one. And you have to be disciplined enough to be able to do that. So looking at our template here, this is not the right time to buy. This is the right time to buy. This is the wrong time to buy. This is the right time to buy. And keep doing that over and over again. Now, once a trend changes, and you can see here that stock prices turn downwards, you can see now, even into a downward swing, you can see some extendedness. So here we have a downtrend line. Notice I've drawn it by connecting the tops, whereas an uptrend line I connected by drawing it through the lows. And you can see that from the trend line, prices streak down very, very quickly. And this is now what we call an oversold condition. Oversold because you have too many people selling it in perhaps in panic mode, and they've driven the stock price way much lower. Now, in an oversold market, especially one that's turning from an uptrend to a downtrend or a sideways trend and then a downtrend, remember there are a lot of people who are still out there waiting for an opportunity to buy this stock. And when you get these oversold conditions out, you're going to get a lot of people who are waiting on the sidelines saying, wow, it's been some time since that price came back there. I'd like to take some now. And it encourages some bargain hunting. So these oversold swings that fall fast too soon, it allows people to be able to look for an opportunity to bargain hunt. And that bargain hunting activity will create the rally. And so in an oversold condition like this, you see the rebound power comes up to be quite strong in this case, but look at where it rallies to your trend line. And then after that, the stock falls away again. It becomes oversold. But this time, instead of falling much sharper like this, it starts to wind sideways. Okay, and then as it comes closer to your trend line, more pressure is delivered by sellers, and then another decline comes back until it's oversold, and then here comes another rally. So the learning lesson we have in this declining situation is, if you have a position in a downtrend, the best time for you to sell it is after it makes a rally closer to your downtrend line. And don't just come around to chase prices on the downside, because you probably will end up selling at a very lousy price. So that level of discipline has to be inculcated with many of us, so that we have to understand that we only move as it moves out of the range of extension. Okay, so if you are currently buying this stock and you think you want to take some profits here, it might be a good idea for you to do it. But since you are still aligned into an uptrend, if you're going to do any profit taking in an uptrend, you should have probably maybe look at maybe 10 to maybe 30 or even 40% of your position. The rest you should keep because the uptrend remains. It's only when the trend changes or your trend line breaks that you should be unloading a fair amount of your position. In a typical correction or slight correction without a trend change, you should be holding a bulk of your positions in there while the trend remains. And you only take some profits when it becomes too extended. Now, I'd like to demonstrate for you the different types of corrections that you see and that we talked about earlier. This is an example of a correction in price because it actually withdraws the price from the high band all the way to your trend line. Just like this, it moved from way up here to this decline. Here, in this case, the correction is a correction in the opposite manner because instead of correcting going down, this is now a downtrend. So your main trend is down. A correction in a downtrend means it has to rally upwards because it's too extendedly into a decline. A rally is that correction that fixes that exaggeration in the decline, and this alleviates that particular pressure. Okay? Now, in a correction over in time, you will notice that the correction in time it could be a combination of a little bit of price movement downwards, but generally you will see it sidewind, up, down, up, down, up, down. And that winding phase allows the stock to be able to regain energy within that condition. Okay, here you can see the same thing. Prices had fallen down, maybe not as sharp as this, but after a while it rebounded, fell down, rebounded, and fell down, and it wound up before attempting to be able to take in a lot of supply and cast the next decline right after that. So sideways corrections are corrections over in time, whereas very deep or sharp moving corrections are corrections made in price.